Yeah, well, maybe an example from a few years ago was a lot of analysts who I found were a lot younger than I was were suggesting that we buy Bluescope Steel, and they were saying that steel prices were going to go up and the Aussie dollar was going to go down, and that's very much a Goldilocks scenario for Bluescope. But in my experience, it was unlikely. Often, if steel prices are going up, commodity prices are going up, and that's generally quite positive for the Australian dollar. And so, we took a contrarian view and we shorted some Bluescope, and that proved to be the right call as import competition eroded Bluescope's margins. And I think that's something we do. We spend a lot of time talking to the market and reading research, but often we're looking for opportunities where the market's getting it wrong. Well, I think the biggest consensus, there are a number of consensus trades, and we like to question that. And so one of the biggest consensus trades at the moment, I think, is the market's tired and needs a correction. And I think what happened in February last year and December last year, the market tried to go down, but just the kind of power of buying pushed it higher. And I certainly think that it's too early to get too negative on the market. I think with bond yields where they are in Australia, it makes the equity market look very, very cheap. And on our analysis, the last two times there's been such a disparity between earnings yields and bond yields have been very good times to buy the market. Those two times being 2012 and 2009. And the following year returns are very, very strong. So there, I think that's one area where we're a little bit different. We're not getting too negative on the market at the moment. And two other consensus trades, as I call them at the moment, are interest rates have got to go higher and volatility's got to go higher. And interest rates, in our view, they may go higher, but I don't think that's a lay down misère. I think debt levels in China and the US are very similar to what Japan was 25 years ago. And over the last 25 years, debt levels in Japan have risen a lot and interest rates have continued to fall. And so I think we easily could see a similar situation in the US and China where interest rates stay low or fall over the next 5 or 10 years and debt levels continue to rise, which is a natural response to higher interest rates, or to lower interest rates. And the other area is just in terms of volatility, and I think there's always going to be macro factors driving volatility. But as a humble bottom-up stock picker, I look at the profit and loss statement, and there's less leverage in the profit and loss statement than there has been for a while. There's less operating leverage and there's less financial leverage. And so that would suggest, from a bottom-up perspective, low vol is here to stay.